Assalamualaikum warahmatullahi wabarakatuh. Today we are looking into chapter 3 of the financial accounting based on the textbook. I'm recording this session so that you can have a review first before we can go into the tutorial or the questions so that we can further understand the topic better, right? So what I'm going to share with you is that before we go into chapter 3, let's recap what we had in the previous class. Yeah. So if I were to go through, hold on, yeah. Okay, in the last class, we have actually gone through the concept of asset, liabilities, and owner's equity. Yeah, so we have introduced you the three statements. We have the balance sheet or the statement of financial position that shows you the asset, liability, and owner's equity at any particular time. We also have the income statement, or we call it as a statement of comprehensive income. And this statement shows you the revenue and expenses of the company for a period, yeah, for the year ended, for example. And from the revenue and expenses, you can actually determine whether the company is making a profit or loss during the period. And finally, we have also introduced the cash flow, means that a statement of cash flow that shows you the inflows and outflows of your cash during the accounting period. Right, as mentioned earlier, the cash flow we can further look into whether it's an operating activities, whether it's an investing activities or a financing activities. Right, and we have actually gone through the example in chapter 2, whereby the company startup, the owners invest money into the company. From the investment, the company then purchase certain assets, and we have looked at the changes when the company purchase an asset, what happened to their the accounting equation, the asset rating and owner's equity, right? So we have also introduced you the concept of retained earnings, right? Whereby the retained earnings is actually the revenue minus your expenses, right? These are the earnings retained in the company for a several period, is the accumulated portion. It means that every year, whatever profit accumulated by the company, if it's not distributed to the shareholders in the form of dividends, then the money or the earnings earned by the company is known as a retained earnings. All right. How you decide on the retained earnings? It goes back to your profit. All right. Every year, the profit accumulated by the company, if not distributed, then the money is known, the profit is known as a retained earnings. Yeah. So that retained earning is part of the owner's equity, right? So we have identified that the revenue actually increase the owner's equity and expenses reduces the owner's equity. Okay. So we have gone through the transactions of the business, for example, and at the end of the day, we always make sure that the accounting equation for every transaction will always equal. Yeah, means that for every transaction, it could be a movement in cash, it could be movement in your buildings, all right, or your accounts payable, or your owner's equity, all these things. Okay, so this is what we have covered in your, so by right, you should identify by now, you should know already what is your asset, what is your liabilities, and your owner's equity. So in chapter 2, all right, you have understand the transaction for each, the transaction and how it affect your asset, liability, and owner's equity. So in chapter 3, we are going to look into how you are going to actually how you are going to, what I say, that put the transaction into accounts. Yeah, we call it as a ledger, right? And later after the ledger, we introduce you journal. So whether you like it or not, all right, accounting is always about debit and credit. It's not accounting is about, all right, accounting will always involve debit and credit. So what is debit? All right, debit is just a term from Latin, right? So, in order to understand, all right, you must, in order for you to do an accounting, all right, you really have to have a good understanding of your double entries. Why is it called double entries? Because for every transaction, there will always be at least two transactions. Double means that there must be one debit and there must be one credit. So when you have double credit, debit, and credit, then only the accounting, all right, remember that you set off the amount. So then you say that, okay, your accounting equation is in order. Okay, so what you're going to look back is the same throughout the course. You always look at your asset, liabilities, and owner's equity. So what I have actually summarized here, all right, look at this. All right, your asset, liability, and owner's equity must always be equal. Right, asset equals to liability plus owner equity. So we have introduced your asset. For example, you must know what are the accounts. Whenever you look at the accounts, you know that it's an asset. All right. For example, cash, account receivable, land, building, equipment. So again, what is your asset? Asset is anything that will benefit the company. All right. In the in running the business. All right. So you use cash in order to pay. Right. You have your accounts receivable, means that you're going to get the money from your debtors. Then you may purchase a land or building that you use for your business, as well as your equipment and many others that can fall into assets. So these are just some of the example of accounts that will fall under asset. Okay. This is actually, yeah. Okay. And on the other side, we have the, okay. On the other side, we have the liabilities and honest equity. All right, liabilities on honest equity, we'll call it as a, for example, liability, we have accounts payable or notes payable. So there are two different accounts. Generally, when you look at the name payable, means that you have to pay in the future, means that it's a liability to you. All right, you have to pay that expenses in the future, in the near future, right? But honest equity, not always start with your stock, right? Wherever an investor put the money into the business, then you have a share capital, stock capital. Yeah, so you open an account we call stock in the textbook, but normally in Malaysia we call it as a share capital, right? And then remember that from honest equity, we also have the revenue and expenses. Okay, so what we are going to introduce you in chapter 3 as compared to chapter 2 is an extension whereby using the same accounts, right, we're going to introduce what we call the T accounts. All right, why you call it T? Because it looks like T. For example, here, see, it's a T here. Nampak T. All right, that's why namanya T account. So what we have is that a T account, we have two sides. All right, T account, that's why namanya T. Right, you have two sides. This is what we call credit. All right, so sorry, this one is a debit side, the left. Right, your left side and your right side. Okay, so DR go for debit. Right, credit here is a right side. Right, can you remember that? You have T account, and T account have a debit and credit side. Debit is on your left side, credit is on your right side. Okay. Why is it so important for you? Because whenever, remember last time when we go into any transaction, you have to identify whether the transaction involves an asset or is it a liabilities or honest equity. All right, so whenever you go through the transaction, you have to look, okay, what is it? Okay, if there's an asset increase in the company, or there's a reduce in asset. Asset in the form of what? Maybe in cash or buildings or land, as mentioned earlier, right? All these accounts, asset. Which one is actually affected from the transaction? Or it could be an accounts payable. It could be a notes payable, or it could be a revenue and expenses. First, you have to identify from the transaction which account is affected, right? And which account that you must know the account, is it an asset, liabilities, or honest equity, right? So in other words, we're going to identify that any asset account, it has a debit in nature, right? We call it a asset account has a debit, and liability and account owner's equity, we have a credit balance. Can you remember that? Asset are the debit balance, liability and owner's equity has a credit balance. If you look at the here, all right, you can see that all the asset is on the debit side and all the liability and owner's equity is on the credit side. Does it make sense? So you know that asset is always debit, liability and on equity is on the credit side. You get the idea? Okay. Because I'm not going through the textbook, the slide, because you can actually read the slide. I just want to summarize. Okay. So once you have that, why do you call that asset is a debit balance and liability on it is a credit balance? Because the nature of the accounts, all right? For asset, whenever there's an increase, example of increase in asset means that, for example, account receivable pays the company. So there's an increase in your cash. Cash is your asset. So whenever there's an increase, all right, we call it here, let me change the color. Okay. Okay. Right. So when there's an increase, all right. So here is what we call on the asset side. Whenever there's an increase, that's why the arrow is going up. So there's an increase. It will be on the debit side. So that's why we call asset. Bila ada increase, debit the accounts. But the other way around, if you have a decrease in asset, then you're going to credit the, so here is a decrease. So if whenever you have a decrease in your asset, you're going to credit the accounts. Alright, so remember satu je, kalau asset, increase debit. Liabilities and owner equities is the other side, so any increase is on credit. Always remember LNOE is increase on the credit side. So bila di increase, dia akan credit. When there's a decrease, there will be a debit. Okay. So remember again, debit, credit, left and debit. So you have to identify asset or liabilities. If asset increase is a debit side, and if the liability and owner equity is on the credit side. Okay. So then only you will be able to identify the transaction. Okay. Okay, this is the what it says now. Right, asset liability, where asset debit, liability owner equity is credit when there is an increase. So you ingat satu je lah. If there is an increase, it's debit for asset, it's credit for liability and owner equity. So we have asset have a debit balances and liability and owner equity have a credit balances. Okay, let's look at the transaction here. All right, January 20th. Michael McBrien and his family invested $80,000 in overnight auto service and received 8,000 shares of stock at $10,000 per share. All right. So what happened is that you have number one here. Okay, yeah. Okay, this one is not good. Hold on, yeah. So identify which account will be affected. So when an investor put money, number one here, the first transaction is that you have money comes into the company, means that you have a cash. All right, cash increase or decrease? Cash increase by how much? 80,000. How did you get 80,000? Because the shares is 8,000. All right, whenever I have that small, means that 1,000, 000, yeah? Times by per share is 80. So 8 times 80 ringgit per 8,000 shares times by $10 per share, then you have 80,000 cash in the company. But remember that cash, what you receive, but you also have to generate the share capital, or we call it as a stock, capital stock, right? I put it as a capital stock. Okay, it's not doing. Okay, capital stock also increases. All right, how much increases? By 80,000. What is this? Okay, we have capital stock. So what do you understand by here? Cash. If I were to say cash increase, cash is an asset. Capital stock is an owner's equity. So if you were to put that into an account, you're going to open two accounts. We call the account as the cash accounts. All right. And then capital stock accounts. Capital stock is always capital stock. Yeah. So then you go back. All right, cash is an asset. Capital stock is a honest equity, isn't it? So whenever cash increase, it should be debited or credited. Cash is an asset. When asset increase, you have to put here as a 80,000, right? 80,000 cash in debited, right? And credit CS means that capital stock, you're going to, why you want to credit? Because this one is honest equity. Honest equity, whenever there's an increase, remember just now I said honest equity, whenever there's an increase, you're going to credit the account. So you're going to credit 80,000 here, okay? So how you know what this 80,000 for? It means that this cash that you get, a cash account, where do you get the money from? It's from capital stock. So you put that as a capital stock as a reference. Similarly, this capital stock, why you created this capital stock? Because you have injected cash 80,000 into the company. So that's how, that's the description for the account. Are you following now? Right. So now cash increases 80,000, capital stock increases 80,000. All right. And you know that cash is an asset. So any increase in asset is debited. Any increase in honest equity is credited. So that's why you have the T accounts in such a way. Okay. Number 2. So let's look at the next account, the next transaction. Overnight purchase land for 52,000 cash. Right? First, you have to understand what is happening. The company overnight purchase land. So now you have land. How much is the land? 50,000. So when you purchase, how do you pay the land? You pay by cash. How much you pay? 52,000. So when you purchase land using your cash, means that there will be a change in the accounts whereby you have now, right here, number 2, you're going to have number 2 here. Your number 2 here is that you have increased your land. Now you purchase land. Previously you don't have land, now you have. So it means that there's an increase in your asset. So land is your asset. How much is the land? 52,000. How do you pay? You pay by cash. Okay. What is a cash? Cash is also an asset. But when you pay out by cash, do you think that your cash reduces or your cash increases? Right? Bila you pay out means that your cash reduces. So bila you reduce, you're going to put it like this, right? Cash reduce. How much you use cash? 52,000. Means that cash reduces by 52,000. So if you were to write another account, you see that you have a new account which is land. So you open up a T account land. Okay, you put it as a land. Land is an asset. So when there is an increase in land, you're going to debit the account. Debit is on left or right side? On the left side. So 52,000. Right? How you pay the land? You pay by your cash. So when you pay cash, means that you are going to affect your cash account. And remember that you already have cash account here. So you do not want to open new accounts, all right, if it's already there. Okay. So if you want to have this, then you have, now you are going to have, no, not this one. Escape. Command Z. Already. Okay. So now, right here, right, you already have your cash account. So might as well you use the same account so you don't have to compute a new one. So here, what you have to credit your cash. Why you credit your cash? Because there's a reduction, there's a decrease in your cash account. When there's a decrease, means that you're going to credit the account. So credit the account for what? Because you purchase land. Right now you have debit and credit. You debit your land account 52,000. Okay, not 80,000. Right, it should be 52,000 only. Okay, this one is your land. So you use cash you take out your cash, reduce your cash 52,000 to pay for the land. So in this case, the changes is that there's an increase in land in the form of asset, but also asset reduces by the same amount in the form of cash. So you're accounting, all right, because you have increased 52, reduced 52. So on the same side, it will be no changes. All right, means that dia take off each other lah. Yeah, so dia settle. Okay, that will be your second transaction. Let's look for the next transaction. Nak warna apa pula? Warna ni lah pula. Okay. Next transaction we have okay. Where is it? Okay, I put it here number 3. Okay, on January 22nd, overnight purchase a garage. Remember garage last time we transferred that into a building for 36,000 by paying 6,000 in cash and issuing a note payable for the remaining $30,000. All right, so what happened is that now you purchase a building, right? Garage, you can put a garage, but normally garage is part of a building. So what happened is that now you purchase a building, right? How you purchase a building? How much is the building? The building costs you 30,000. Sorry, 36,000. But how you pay that 36,000? You pay by cash of 6,000, and then you also pay the balance in the form of note payable 30,000. If you look at here now, building 36,000, but you pay cash now 6,000, and you pay later 3,000. So it means that you're going to total 36,000 lah. Right? That's the term of the payment. So what happened here? What is an asset? What is a building? Building is an asset. Do you think that here building increase or decreases? Because you just purchased your building. Before this, you don't have any building in your business. Now you have a building. Means that there is an increase in your building. Cash. Right? Initially, you have cash in the company, but now you have to pay out 6,000 because purchase the building, so cash reduces. Right? And then you have notes payable. Notes payable in the form of a liability. Remember that it's a liability. So do you have a notes payable before this? No, you don't have any notes payable, but now you have your notes payable. Yeah, but it means that notes payable is a liability, cash is your asset. I'm not sure why is it not. Cash is your asset. All right, asset decreases here 6,000. Notes payable liability increases by 30,000, and building increases by 36,000. Right? From this transaction, I want to show you that, right? What we are going to have is that we are going to have a building. Do we have a building just now? We have land, right? We don't have any building yet. So we're going to create a building account. Right? What is the name? The name is building. And remember, building is an asset. So what happened here? You have increased your building by 36, right? 36,000. But rather than having that building as 36,000, yes, you can have it like that, right? All right, so why you debit your building? Because the building is an asset. That means that increase in asset, you are going to debit the account. But at the same time, you also have cash account there. Cash decreased by 6,000. Okay, so cash ada account kan kat tadi kat atas ni, you already have your cash. So kat sini you letak building. So using the same account, you have a building of, you pay building for 6,000. Are you following me? Okay. And remember that now we also have accounts payable. In this case, it's notes payable, and notes payable is a liability. So you open up a liability account, increase or decreases, increases. Liability increase, debit or credit is going to be a credit. Why you pay these notes payable? Not pay, it means that you created this because you purchased a building amounting to 30,000, right? So here actually, right, you can have it like this, right? Instead of having 136,000, right, you can have it in the form that, for example, rather than having that 136, right, so that you can track, so means that building here you pay 6,000 by cash and the balance 30,000 by notes payable. Dia dah macam when. Okay. Notes payable. 36. Okay. So that what happens to the transaction when you purchase a building 36,000 is an asset, but you pay out cash, so you credit your cash. Oh, you sorry, yeah, debit and credit. You credit your cash because there's a decrease, and notes payable you have to credit as well because it's a liability. Okay. Next transaction, number 4. What do we have? Note number 4. We have purchase tools and equipment for 13,000 on account. So whenever you see this term on account, right, it means that this is on accounts payable. All right. So what you do is that what happens is that you purchase the tools and equipment. All right. You have tools and equipment, and remember that what is this asset? Yeah, it's an asset. And then you also have your accounts payable. Now you open up your accounts payable. Tools and equipment is an asset. How much is the asset? 13,800. I put as a 13.8, but you purchase by accounts payable, right? So accounts payable is a liability. So there's an increase in accounts payable. Therefore, it has to go into the credit side. How much is it? 13.8. You put it as a tools and equipment, right? So in this example, they just put the date, but they don't put the description. I want to show the description because that reflected in the account, right? When you look at account payable, what is it? 3.8. Oh, this for purchase of tools and equipment, right? And tools and equipment, when you look into the account, you know that, oh, this one I purchased on credit, right? I have to pay my creditors later. Okay. So far so good. Okay. And now we have overnight parts sold the tools and equipment to Ace for 1,008, price equal to overnight cost. Ace agreed to pay overnight account in the future. So what happened here is that you just purchased the tools and equipment 13,800, but now you sell this is an asset. Remember, you have opened up the tools and equipment just now. So now when you sell or sold part of the tools, when you sell means that your tools and equipment not increase or decrease. Of course, the tools goes out from the business, all right, because you sell, so it means that your tools and equipment goes down. It decreases. So when it decreases, it's an asset. Will it decrease? What happened? You're going to credit the account. So that's why you already have your tools and equipment here. Then you're going to credit 1.8. You don't have to open new accounts, right? What happened? Okay, tools account 1.8. But now you have what you pay. In this case, when you say that you are going to sell, right, you are going to receive the money in the future. So bila receive money in the future, what do you call the account? Accounts receivable. Account receivable is an asset, right? So when there's an increase in account receivable, before this ada account receivable, but now you have account receivable of 1,800. Why you debit? Because account receivable is an asset. There's an increase by 1,008. Before you tak ada, now you ada means that there's an increase. Yeah, so in that case, you have tools and equipment here. Here is accounts receivable. Right? So that's how you put your transaction into a ledger. Right? We call this as a T account. Yeah, you posting your transaction into your T account. Right? You get it? So it always goes back. For every transaction, you have to identify whether is it an asset liabilities or NS equity. And then you say, okay, is the account asset, is it increases or decreases? Right? Then you can decide whether it should be on the debit side or credit side of the account. Okay, but in actual, all right, normally before we go into these T accounts, what we do normally, we put that into a journal entries, right? So if you were to put into journal entries, I put here journal entries. What is a journal entries? Is a posting, right? We post the transaction into the journal first before we put that into the T accounts, because we want to reduce the we want to make sure, okay, we know where is the debit and credit first, then we post that into the account. All right, for example, number one just now, all right? So let's go back, right? When the company, when the owner put the money into the business, 80,000, remember? So when was that? Number one, where we say that, okay, put the money. So you remember that you debit your cash account and credit your capital stock. So if you want to put that into a journal entries, you always have to put just like this, right? You identify which one is the debited account to be debited. In this case is cash, and you're going to credit the capital stock. How much? 80,000 each. So this is what we call journal entries, all right? So, and then of course, at the journal entries, you will have one line that describe what is the transaction. So in this case, the description here put that owners invest cash in the business. All right, if you look at here, all right, you always have to put here debit and credit. You always start with debit entries first, followed by the credit entry. And the credit entry is indented a bit, all right, to the right. Yeah, it has to be indented a bit to the right to show that, okay, this one is the credit. So remember, credit is on the right. That's why logically you have to indent a bit to the right, then you put credit. All right, and then put the description here. So you have to put, okay, what is this transaction? In this case, it's owners invest cash in the business. Okay, can we try, if you want to put this into a journal entries for the second transaction? I think that because here they don't show you. Let's do that into journal entry. Number one, we have done that. Number two, can you put that into your journal entries? In this case, what is the transaction? You purchase land, so you're going to debit your land. So you always have a debit entry here. Okay, you're going to debit. What is this? Debit your land. I'm not sure lah. Kenapa kadang dia okay, kadang dia tak okay. So debit your land. In this case, land, you purchase land, and then you're going, how you pay by. So remember, credit will always be indented a bit. So you indent ke dalam sikit, baru you tulis credit of your cash. Right, whenever you credit means that you ke kanan sikit kan, to the right. So how much is the value? Land is 50,000 and cash also you paid out 52,000. And don't forget to put the description purchase of land by cash. Number three, how you're going to put that into journal entries? Number three, okay. What is the third transaction? So how you're going to put this? You purchase a building, cost you 36,000, and how you pay? You pay by cash and you also pay by note payable in the future. So you debit your building. How much is the building? 36. So you look at this, yeah? Debit building 36,000. But how you pay? You credit, all right, indented a bit. You pay by cash, all right? You pay credit by cash 6,000. And you also pay later by credit your note payable. How much you pay? 30,000. So 36 plus 30, you see that on the credit side is 36,000, which is similar to your debit side, which is also 36,000. So in that case, you know that your debit and credit is the same. The other transaction, you know, debit credit is 1, 52, 52, 80, 80. But in this case, you have 3 entries. which is the building, cash, and note payable. So you must make sure that the debit side, which is 36,000, is the same as the credit side, which is also 6 plus 30 give you 36,000. So then in that case, you know that your double entry is correct. Yeah. Okay. What about number 4? So how are you going to put that into a journal entries? Number 4. Okay, let's look at the transaction number 4 again. You purchase tools and equipment for 13,800 on account. So in this case, remember what is debited? Right, you purchase a tools and equipment. So tools equipment is your asset. There's an increase, so you're going to debit your oh lah, penny. Okay, debit your tools and equipment. Tools and oh my god, what happened? Tools. All right, you debit your tools and equipment. How much is it? 13.8. And then you credit. Remember your credit, your accounts payable. How much is 13.8 also? So in this case, your debit and credit is okay. Yeah, and you know that your tools and equipment is your asset. Increase in asset, you debit. Account payable is credit, is a liability. Increase in liability, you credit the account. It goes back to your basis. Yeah, number 5. Okay, what is the fund? Number 5 transaction is, okay, you sold part of your tools and equipment. So when you sell, right, your tools and equipment reduces. But what increases? Accounts receivable. So accounts receivable is an asset. So in that case, you know that you're going to reduce, right? Sometimes you're not sure what is your debit and what's credit. You can write like that. Okay, but you know that your tools and equipment is an asset. It decreases. So when the asset decrease, you're going to credit the account. So you know that credit is the tools and equipment. How much is it? 1.8. Debit means that you're going to have that in the future accounts receivable. So how much is it? 1.8. So this is how you put your journal entries for each transaction. So normally in practice, what we do is that we have the journal entries first, then only we post into the T accounts, right? So whenever you have this, all right, then you are going, we say that you are posting it to accounts, right? So what else we have? Okay, I think this is the last transaction. Okay, posting. Okay, this one I have shown you actually. Okay, now we want to look into your accounting statement that shows you the, the income statement that shows you the revenue and expenses. All right. So this is another. We look into the revenue and expenses. Okay. So remember that revenue and expenses is part of your owner's equity, right? Revenue and expenses. So whenever you have revenue, means that you make sales, and of course, when you make sales, who's happy? Your owner happy lah. All right, your owner's equity should also increase. So whenever you have a revenue, that increases your owner's equity, right? But whenever you have expenses, expenses reduce your owner's equity. Okay, owner's equity, remember, is a credit side. Remember, asset, liability, and owner's equity. Owner's equity is on the credit side. So whenever increases, all right, it will be credited. So for revenue, because revenue say that revenue increases. Whenever you have revenue, you increase your owner's equity. So whenever you have a revenue transaction, all right, whenever you have a sales, for example, all right, sales is a revenue. So you're going to credit the revenue account. Why you credit revenue? It goes back that revenue increases honest equity. So honest equity is a credit in nature, credit balance. So any increase, you're going to credit the account. Okay, but for your expenses, right, expenses reduces your honest equity. So it reduces your honest equity. So whenever you reduce your honest equity, you're going to debit the account. Right? It always goes back to our first principle. We say that, okay, where is it? So honest equity is on the credit side. Whenever there's a decrease, you're going to debit the account. Right, nampak ni? Okay, here. Right, honest equity, whenever there's a, so whenever talk about honest equity, is to talk about expenses. Honest equity increases in the form of revenue. Okay. So now we go into example and to see that how is that the transaction that involve revenue expenses will affect your accounts. Okay. So, but remember that what else? So, revenue increases, decreases, matching principle, matching. Okay. Okay. Let's look into this example. It says that in example 1, we say that again, we put that number 1. Now tukar warna. Change color to blue balik. Okay. Okay, number 1. You say that Daily Tribune 36,000 cash for newspaper advertising to be run during February. So now you say that you paid Daily Tribune. Daily Tribune is a newspaper lah. So means that you paid Daily Tribune 3,660 ringgit cash for newspaper advertisement. So in this case, all right, when you make payment, all right, you pay 36. So of course, your cash decreases. Right, cash decreases, but at the same time, advertising here, how are you going to recognize advertising? Is it asset, liability, and honest equity? Advertising is not an asset, it's not a liability, but it's an honest equity. But in this case, advertising is an expense, so that's why you pay for your expense, right? Anything that you pay, most likely is for your expenses. So expenses, the nature is, well, the nature of the expenses, debit. Nature of sales, revenue is credit. Okay. So whenever you have advertising, you put here as though you're going to debit advertising. All right. How much is it? 360. How much did you pay for your? Hold on, yeah. Saya pun dah sakit jantung lah tengok benda ni. Dah sakit jantung tengok ni. I punya pen ni macam it's not working well. Keep on having to take off up and down. Okay, 360. Then you have a credit your cash. Remember that credit you have to indent it a bit to 360. So what is this? Payment paid cash for advertising. Right? You pay 360 for your advertisement expenses. So that's why here is an expense. That's why you debit. So if you to put that into your T accounts, you're going to put it like this. You're going to have the advertising expenses. So debit or credit, debit 360. How you pay the expense by cash, right? And then you have the cash account. In this case, if you continue from the initial cash, right, you have to credit your cash 360 lah. Right, expenses. This one is for your advertising. This one is cash. Right. Remember that if it's the same company within the same year, then you don't have to open new cash. So you just have to reflect that in your cash account here. All right. Now you have your advertising. How much is it? 360. So it has to be in the same account. So you don't have to create this, but I show you here so that you can see the movement, the changes of from this transaction. Okay. And then what we have next is that we have a purchase radio advertising from Crown to be added. Again, here is this purchase radio for crumb to be at the cost of 1% payable within 40 days. So in this case, number 2, right? What's the difference from the first one is that in this case, you pay again for the advertisement. Number 2, right? Your journal entry still for your advertisement expenses. Debit your advertisement, advert, advertisement. I cannot. Expenses, all right, how much you pay for it? For you don't pay it, yeah, it's you pay in this case, you purchase for 70, but you don't pay, but you pay that in the form of accounts payable, means that you pay later, right? How much? For 70. So in this case, you already have your account advertisement. So you just add on another 470 in the same account. You put as accounts payable, and you have just now accounts payable. How much is your accounts payable that you have at the top? I think they already have accounts payable here. See, here you already have your accounts payable. You can put here as your advertisement. How much is it? It's for 730. So because you already have the account, so you don't have to create another account. Yeah, otherwise you have a lot of accounts. Okay, and here is you purchase supplies, right? Okay, supplies here is supposed to be used in the next 3 to 4 months. Right, supplies here in this case it become an asset first. All right, so it's an asset, then you debit your asset, credit your, what's happening now. Never mind. All right, you debit your shop supplies, credit your accounts payable. The problem is now is that untuk stop sharing sekejap. Okay, now maknanya dia dah hang. Okay, my computer is hang now. Where is it? Okay, I have to stop recording. But it seems that everything went wrong, so I might as well shut down. I can't even shut down.
It's 1 o'clock.